Welcome to video 9, the basic technical analysis video. We will talk about 1. Trend, 2. Support and resistance, 3. Price patterns, 4. Candles, 5. Common indicators. Something I want to cover real quick is bullish and bearish. Imagine a bear stomping down with its 2 front paws on prey. Now imagine a bull running up and swinging its head up to gore something, or that bear. Okay, so when I say bearish, it means price going down like the bear pushing down on its prey. When I say bullish, it means the price is going up. And if I say apish, it means you just hold on like a total moron, or somebody supremely wise if you make a lot of money. First is trend. There's an uptrend, sideways, or you'll also hear it called ranging and consolidation. And then there's downtrend. Uptrend, ranging, downtrend. Uptrend has higher highs and higher lows, as you can see on these many examples. Sideways is exactly what it sounds like, and the price is ranging up and down and not really picking a direction. Downtrend creates lower highs and lower lows, as you can also see from the many examples. Trend is your friend. Is it easier to swim up current or down current? In a river, that is really easy to figure out, but for new traders, I think it can often feel like you're in a rip current. It's extremely difficult to swim into a rip current, so you swim out of the rip current to the side, then in. Let's see if we can help you identify trends quickly in your trading journey. This is probably the most difficult idea to implement at first. In the bottom right example, you can see price ranging on the hourly. It hasn't chosen a direction, so between these white lines. It hasn't chosen a direction, but if we move down to a lower time frame, like the 5-minute, a trend can be identified to trade in. If you were to try and trade the hourly, you would zoom out to the daily to see if you could identify a trend. I suggest moving up 2 time frames to identify an overall trend for the time frame you're trying to trade on, either 1 or 2 time frames. Drawing lines and saying this is a trend is nice and all, but the market doesn't move in perfectly symmetrical patterns. Once again, in the picture on the bottom right, you could look for buys on the 5-minute in the green zone and sells in the red zone. Here are some other examples to further illustrate the trend. In this picture, I've identified support and resistance levels on different areas and on different time frames. So price comes down to support. This means people are buying, so the price moves up, and then people start selling here. So this is an area of value where people think price is a good price, so they buy here. In this picture, I've identified support and resistance levels on different areas and on different time frames. Here are some images to further illustrate support and resistance. Here we have identified we're in an uptrend. We've also identified support and resistance. Many traders, after identifying support and resistance, will sell at resistance and buy at support. When resistance is broken, it can become a new support, and when support is broken, it can become the new resistance. Another method of trading is to sell at the new resistance line or buy at the new support. So you can see price comes down to this area, and it's an area that's considered an area of value, so people or institutions start buying, the price goes up, and then we see a rejection off of resistance, and then price will either respect support or break through it, and if it breaks through it, then often it will come and back test the support that is now the new resistance, and then if it respects the new resistance, often people will sell here. Same for the other side. So if price is respected on this support and it breaks through this resistance, often it will come back and test this old resistance as the new support, and often people will buy here. Here's another method to show how some of these ideas can be used in trading. In this example, you can see the resistance is broken, taking out stop losses. Then price comes back and knocks out all the stop losses from traders with the method I mentioned earlier of identifying the old resistance as new support. So what a trader will do is, if they expect price to support this resistance, then they'll say put a sell here, a sell limit. So when the price comes here, they'll sell, and then if it breaks through where they sold, let's say they put a 1% risk, so it's here, and if the price moves past where they're beyond the point that they're willing to risk, let's say 1% of their account, then it will close the trade, they'll lose 1%, and they'll be able to trade again. So if they didn't put the stop loss, let's say it blows their entire account, they just lost their entire account on one trade. So they risk 1%, so they have over 100 opportunities to trade the market before blowing their entire account. So then the price goes all the way to the old support, knocking out more stop losses. Then it returns to the old resistance as there's no more liquidity to grab, and it's a previous area identified as a selling zone. The price bounces back down. As I've said before, stories are told like this, that institutions are liquidity hunting, but all that really matters is identifying a pattern that gives you a consistent enough edge to remain profitable, whether it's true or not. So what I'm trying to say is, often people will just tell you a story and it sounds good, but it doesn't matter what the story is or even whether it's true or not. All that matters is whether you can find a pattern that you can take advantage of and be profitable. 3. Price patterns. First, we'll talk about triangles. They're symmetrical triangles that show price consolidating into a smaller range until there's a breakout. It gets smaller and smaller and smaller, and then it breaks out. On an ascending triangle, you can see the same price range is continually tested, and the support price keeps rising. Support keeps rising. The support line is moving up. Resistance is staying the same until it reaches a breakout. On an ascending triangle, you can see the opposite situation playing out. It's considered a bearish pattern. Resistance lower and lower, support staying the same until it breaks down. Once again, the market doesn't move in perfectly symmetrical patterns. Here it is drawn out more symmetrical. Don't expect patterns on the charts to be perfectly symmetrical, and I suggest using a rule of a minimum of 3 touches to identify lines in your technical analysis. Now we'll cover flags. On the left, you'll see a bull flag, which is considered a bullish move, and a bear flag on the right, which is of course a bearish move. Then we have the head and shoulders as pictured, and there's also a reverse head and shoulders and a double top and double bottom, which is supposed to identify a point of strong support or resistance. Head and shoulders and inverse head and shoulders. Lastly, we have the cup and handle, which is popular in stocks trading for signaling a reversal in the price. Now we'll talk about candles. If the candle is green, it means the price opened lower than the close, and the candle closed higher than it opened. If the candle is red, the candle closed lower than where it opened. The wick is the distance the price traveled while the candle was still open. If it's an hourly candle, the price moved to the top and bottom of the wick through that hour, not necessarily in that order. I will be showing you 3 types of candles. The 38.2 green closes above the top half of the candle in green, and the 38.2 red closes in the bottom half of the candle in red. The green is bullish and the red is bearish. Then we have the engulfing candle. When the previous candle is engulfed, it means the buying pressure or selling pressure is increasing. This can also be verified by the volume. 5. Common indicators. We'll talk about the moving average, RSI, volume, MACD, and Bollinger Bands. This is just a basic overview so that you understand a little bit about what they are and aren't too confused in future lessons. You can see them all here on one chart. I have 3 moving averages on the chart. They're blue, orange, and white. The RSI on the bottom is a blue line right here. The volume has a big green candle, and notice it didn't move the price very much right here. This is the price movement. This is the volume, large green volume candle. That means much was sold when there was a buyer lined up, so it didn't affect the price hardly at all. The MACD has a wave pattern that fluctuates from red to green in a blue and orange line. The Bollinger Bands are the MACD is right here. You can see bullish, bearish, and the lines. The Bollinger Bands are the red and purple and yellow lines. Red, purple, yellow. One, moving average defines current direction of the price with a lag. I have the 5, 13, and 62 MA listed. And when I say MA, that means moving average. The 5 shows the average of the last 5 candles divided by 5. Same formula for the rest. It can be used to identify the direction of the trend or define support and resistance. A popular method is to watch when some of them cross each other or the price. Moving averages are in here. Blue, orange. Blue, orange, and white. RSI, a momentum oscillator that measures the speed and change of price movement. It's typically used to see if the price has hit overbought or oversold and can show trend. Here's your RSI. You can see there's an uptrend clearly identified here. Volume shows the amount of volume at a particular price range. It can help identify momentum and supply and demand. As I said before, you could tell that there was a buyer and a seller lined up because of how much it didn't affect the price, and you can see the prices moved a lot more with far less volume in other places. MACD, momentum oscillator that offers trend following and momentum, not useful for seeing overbought or oversold. The 2 lines are moving averages, typically the 12 and 26. The colored wave is the histogram, and red is bearish and green is bullish. Here's the MACD. Bollinger Bands, it's typically the 20 MA with a line 2 standard deviations below and above it. It's a quick way of identifying volatility. The closer the bands are together, the less volatile the price movement has been. Red, yellow, and purple. Alright, nice work. No homework. We'll play with charts the next lesson. Stay symbiotic, and good luck on your trading journey. If this has been any value to you, hit the like button, subscribe, or share with your friends. I wanted to mention part of the reason that I'm doing this training the way that I'm doing it is so that anybody that speaks any language can learn through this training. So I try to stick mostly to my script so that somebody that speaks Chinese or Spanish or whatever can learn. And if there's enough demand, I'm happy to do these in Spanish. Porque yo hablo español. Pero no sé muchas de las palabras de trading. Pero yo puedo aprender. Entonces, muchas gracias por mirar. Adiós.